What's up, y'all? It's Rob. So I'm going to go through a live play I did this week. I did a straddle during the FOMC meeting. And if you're not familiar with a straddle, let me explain it to you real quick. A straddle is a neutral option strategy that involves buying both the call option and the put option at the same strike price and the same expiration date on the same stock. So this strategy is designed to profit from a significant price movement in the underlying stock, regardless of the direction or move. In layman's terms, you want it to go up or down fast. Part of the risk here is you're getting the cost of two options. So if it trades sideways, it's going to cost you a lot of money really quick. So we're looking for a fast movement in the upside or the downside. So let's talk about time decay. The value of the option contract decreases over time. This can lead to losses if the stock does not go up or down significantly before the options expire. So you got to really pay attention to how long you're in for. So buying a straddle before an FOMC meeting can be a profitable strategy for traders who are looking to profit from market volatility. Basically, whether it goes up or down. It don't matter which direction it goes, but we need it to go quick before we get some big news or before the Fed speaks, usually a good time. Anyways, my reasoning for buying a straddle before the FOMC meetings, because we always see a spike in the upside or the downside. I don't want to have to guess. I was just going to do a nice small one, looking for about 5% gain. I just like to try little stock strategies like this once in a while, and I'm going to walk you through this live one that I did. Alright, first thing I'm going to do is I'm going to take you here onto the Option Strat website, and I'm going to show you what it looks like to create a straddle, and then we'll go into Webull. First thing we're going to do is we're just going to go build. Okay. Now, hypothetically right now, TQQ is at $49 a share, as you can see here. So we're going to pick the $49 call, and we're also going to pick the $49 put to buy both of those. And we're going to do the earliest expiration date. Technically, you could do a farther out expiration date, and then the delta would be lower, and it costs you less to hold these positions, but most of the time people don't do that. Let's take a look here, and if we did one today right now, you'd see we would lose out throughout the day if it traded flat. You can see here where the red's at. We wouldn't start making a profit at 2 o'clock unless it hit 49.52, as you can see over here, or 48.46. Pretty small window when you think about it, but let me tell you, I've done a couple strats, and sometimes it's hard to get them to work out. All right, I'm going to show you a good example of time decay that we were talking about earlier here. You can see if we bought our straddle now. Right now, if it trades flat, we're only at negative 10%, negative 15%, and negative 20%. But throughout the day, it keeps getting higher and higher. That's time decay eating away at those options. Negative 30, negative 40, 50, 60, all the way up to negative 100%. That's why it's important we get that upward or downward movement. Me personally, I run a pretty tight stop loss, about negative 20 to negative 25%, which gives me a couple hours for it to go up or down. If it's not moving in a couple hours and you had a bad entry, it's time to get out while you still can and fight another day. I want to show you how expiration date affects straddle. So if we had one ending today, you can see by the end of today, it's virtually lost all of its value if it trades flat. It would also cost us only $50 to get in that trade right now. If we did the $49 put and $49 call for a week from now on the 22nd, see how that affects it. Instead, if it traded flat all the way through today, most it's going to be down is 1.4%. That's it. It's also, the straddle is going to go from $50 to $212. Our profit margins, where we start to make money, it has to go out farther to be in the money. So be in the money at all by the end of today using the straddle, we'd have to be at 49.56 and we'd be at 1.9%. Let's go back. 49.56 today be 12% profit instead at the same spot. So you can see here, closer expiration date is a lot cheaper, and the percentage if it goes up or down is a lot higher. But time decay, it's a lot higher also. We lose value very rapidly, but if it pushes up or pushes down, we're going to make a lot more money. As you can see, that 49.50, we go on the 22nd. By the end of today, if it hits 49.50, only up 1% compared to nearly 10 times that, the other option. All right. Here on the Webull platform, the first thing you're going to do is you got to be approved for level 2 options trading, of course, but we're going to go here to the options string. Right now, for instance, and this is a separate day from the day I traded it on, current price of TQQ is at 48.55. That's kind of a bummer spot to be. I liked it to be closer to the strikes. That way the puts and the calls will be closer together. Let me show you here. So I'll take it off of straddle for a minute We're going to go on both. So we have the puts on one side and the calls on the other side. You can see here for a 49 call and put for tomorrow, it's $80 and $36. So the problem with this is if the stock price starts going up, we're going to lose that $80 a lot quicker. We're going to gain on the 36 side. If the stocks were closer together, it would be perfect. Then if it starts going one way or another, we're going to get in the money real fast. So anyways, that's what I like looking for when we're getting ready to trade is this, wait till that stock price gets as close to say 49 or 48, whatever the price is you're trading. That'll bring the cost of the calls and the puts closer together. One indicator you can kind of see also is the delta. You got a 34 delta over here with the 31 and you got a 65 delta over here on the $88. You can see here also for a 48 call on TQQ it's $85 and the delta is 0.65, and for the put it's $33 and the delta is only 0.34, which means for every dollar in movement we're going to gain 34 cents on the put side and 63 cents 64 cents on the call side. So it helps out when these are real close together. It's not crucial, but it's definitely going to help the situation out if we get these as close together, the calls and puts. So that's the first thing I do is come and look, make sure the calls and puts are as close together as possible. Once we do that, let's go over here, let's set it to straddle, and let's look. So if this was at, say, closer to 49, we'd click on our 49 straddle. And that's what we got down here. It's showing us that. No, it's defaults to 10 contracts. But anyways, once we're ready to go, puts and the calls are pretty close together. That's when I'm going to go ahead and buy. You can see here, you don't want to sell. If you sell, it would have to stay between 48 and 50 to make money. We want it to go up or down a good amount fast, so that's why we're going to buy the straddle. I'm going to walk you through. I was a little late to the FOMC meeting, but I got in at the tail end right before they started getting to the questioning. That's usually a good time. It bounces right before Powell starts talking, and then once those questions get asked, you don't know if it's going to go up or down. Could go either way. Alright, right here I'm just waiting for the strike prices to get close enough. As you can see, they're almost to $48 here. So now's the time. He's getting ready to, the comments are getting ready to come, so I'm going to go ahead and buy. There we go. I'm just waiting to get a fill here. And Weeble's not the best for getting fills. I keep going back, looking at my working orders. You can see it's still sitting there. I'm trying to get it at 256. I kept thinking about bringing it a little bit higher, going up towards 260. If I would have went towards the asking price at 260, I would have got it a little bit quicker. And there we go. We got a fill. We got filled for 254. And I'm just keeping an eye. I like to watch Meet Kevin. Well, the FOMC's gone to kind of get Kevin's expert interpretation on what's being said, if it's good or bad. But right here, you can see the market's starting to go up nicely. So I'm going to go ahead and try to get it sold for about a $10 profit. So we're going to sell for about $265. And it's going to take me a few minutes to get this fill. Right down a little bit. We're going to go ahead and try to sell it for $265 here. Now you're going to watch the bottom right corner there where it says TQQ straddle, where it says $6.5, $7. That's the total value of the straddle. You can see how the put and the call are going against each other. One's up money and one's down money, and the difference is what we're profiting. So we're up about $7, $8, $9 there, and the tough part is getting a proper fill. It'll pop right up past your 266 over and over again, 265, 266, and you won't get a fill yet because that's just Weeble. You know, we're not paying commissions here, so that's the treatment we get. If you're on Ameritrade or something, it probably would have gotten a fill. There we go. We got filled at 264. I think I kind of got a little gun shy and lowered my fill amount there. Made about $8, $9 and good enough for today. But I'm going to do some more straddles, maybe go a little bit bigger. I've got to do a little more research in the meantime also. I'm not doing this necessarily to show you how to do it. I'm just opening your eyes up to this trading strategy that you can go and research it a little bit farther. All right. I appreciate you watching, and I will talk to you later.